With RBI retail, direct, and online bond platforms, buying bonds today is as easy as ordering groceries. High yields, government backing, predictable returns. On the other hand, debt mutual funds have been the traditional go to for fixed income investors. So, is it time to ditch debt mutual funds and invest in bonds directly? Before you rush in, pause. This choice isn't as simple as fixed versus market linked. The real question is which one protects your capital, saves tax, and gives you peace of mind. By the end of this video, you will know the answer and why for most investors, debt mutual funds quietly win. So hi there, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So before getting into the main part of the video, let us now understand what are debt mutual funds. So debt mutual funds pool your money with thousands of other investors and invest in a diversified mix of instruments like government securities, corporate bonds, treasury bills, and commercial paper. And why investors like them? One, diversification. One, bond default won't sink your portfolio. Number two, professional management. Fund managers track credit ratings, maturity profiles, and interest rate cycles for you. Number three, liquidity. Exit online and get money in 1 to 2 business days. And number four, tax efficiency. No annual tax on interest. Tax is paid only when you redeem, allowing longer compounding. So it's a set it and forget it approach that fits salaried professionals and busy investors. So now what are direct bonds? With direct bonds, you're lending to the government or a company. In return, you get fixed interest and your principal back on maturity. Sounds attractive, right? Especially with online platforms offering 8 to 10% yield. But here's what often left unsaid. Number one, credit risk. If the issuer defaults, your capital is directly at risk. Number two, downgrade risk. A rating drop can hit the market price even if there is no default. Number three, reinvestment headache. Every coupon payment needs to be reinvested manually. And number four, monitoring load. Maturity schedules, credit events, interest rate movements, all on you. For seasoned investors with time and 10 to 15 lakhs to build a diversified basket, bonds can work. For everyone else, this is where debt mutual funds shine. So imagine you just sold a property and want to invest 50 lakhs. Option A, buy a few high yield corporate bonds at 9%. Option B, park it in a liquid fund and use a systematic transfer plan STP to gradually move into an income or dynamic bond fund. With bonds, you would have to choose issuers, track ratings, and reinvest coupons. With the debt mutual fund route, you would get automated reinvestment, professional diversification, tax deferral until redemption, and one is DIY with high responsibility, the other is plug and play with professional oversight. So now let's talk numbers. Buy a bond at 9% yield if you are in the 30% bracket. Post tax, you keep only 6.3% since bond interest is taxed as income from other sources. So, debt mutual funds, no yearly tax. You pay capital gains tax only on redemption. This deferral means more of your money keeps compounding, especially important for high earners. So, over 7 to 10 years, that difference can add lakhs to your wealth without taking extra risk. One bond is equal to one issuer is equal to 100% risk concentration. To diversify, you would need at least 5 to 10 bonds across sectors and ratings. But with 10,000 to 1 lakh minimum per bond, you might need 10 to 15 lakhs to create a balanced portfolio. Debt mutual funds solve this instantly. With as little as 5,000 rupees, you can access a basket of 30 to 50 bonds professionally curated for safety and yield. And platforms like Golden Pie and Wind Wealth are making bonds accessible. But remember, they are marketplaces, not advisors. They earn through spreads and commissions. Top picks may be paid listings. Yield shown or pre-tax, not adjusted for credit risk. Debt mutual funds, on the other hand, are tightly regulated. with transparent NAVs and no need to guess which issuer is paying to be promoted. So, who should choose what? Debt mutual funds are better if you want convenience and minimal tracking, or you're in a higher tax bracket and you prefer automatic diversification and reinvestment, and you want professional risk management without DIY monitoring. And direct bonds can work if you want fixed coupons and can lock in till maturity, and you have capital to diversify manually, or you're in a lower tax bracket and can handle reinvestment yourself. But here's the truth, for 90% of retail investors, debt mutual funds are simpler, safer, and more tax efficient. So, what is the final takeaway? Direct bonds aren't bad. For some, they offer predictability and control. But for most busy professionals balancing jobs, families, and financial goals, debt mutual funds offer what really matters: capital protection, stress free diversification, tax efficiency, professional oversight. Before chasing a flashy 9% bond yield, ask, is the extra 1 to 2% worth the extra risk, time, and effort? When it comes to fixed income, peace of mind is often the highest return. So, still unsure which path fits your financial goals? Click the link in the description to book a free consultation with one of our certified financial planners. We will analyze your task profile, risk tolerance, and time horizon to build the perfect debt strategy so you can grow well safely and efficiently.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.